Hi, folks. Welcome to this training session on whole life insurance policies. My name is Chris, and I'm your exam coach. If you haven't checked us out yet on lifehealthexamcoach.com, I'm inviting you to do that. We are here for you and for all aspiring agents who want to pass their life and health exam. We have a great program to help you do just that. So check us out at lifehealthexamcoach.com. So let's get started with today's topic, which is whole life insurance policies. These policies are called permanent because they are designed to be there for the insured's entire life or whole life. And it's going to provide a level death benefit for the entire life of the insured. These policies are said to mature or reach a maturity date that is defined by the policy contract. Usually that's age 100, but I've seen it be higher, age 110 even. The idea here is at a certain point, if that person were to live a really long time, they are actually going to receive the death benefit themselves rather than it getting paid to the beneficiary. So it's to your benefit to have this be at a late age that you're unlikely to reach, because again, the purpose of whole life insurance is to provide a death benefit to your beneficiaries. So these plans can have living and death benefits. We'll talk about those as we go through our training today. There is some cash value to these policies. You can take policy loans, for example, on that cash value. So there's some things that are different here than term insurance, which we discussed in another training video, that provides some value for the insured and policy owners. So let's jump in a little further and we'll explore those. Before we go further, I do like to share what the four main variables are in whole life insurance, because really all of the different product options that are available are based on varieties of these four variables. So we saw this too if you join me for the term insurance. Term insurance has its variables and they're very similar. Whole life has one additional variable that you see, number two, which is the cash value. So whole life has a face amount or a death benefit. Those are the same things. A cash value, a premium payment, and also a time factor. So all of these variables can be shifted, and that's what creates different designs and different policies that suit the needs of your different buyers. So let's look at some of those different designs. We're going to begin with what's called straight whole life. Now, this is probably the most common, the most, well understood and straightforward, just like the word implies, whole life policy that's out there. You have a death benefit that I have listed here at the top. It's level, right? So it's going to be there for the insured's whole life until it reaches maturity or, again, usually around age 100. On the left-hand side, you can see that you have a dollar sign. That is for the amount of premium. And you can see at the bottom there that it is a level premium. So in a straight whole life policy, you determine a set death benefit. Let's say just for this example, you're looking at a $100,000 death benefit. So you're going to pay a specific premium and that premium is going to be paid for the insured's entire life. Now, that premium will be determined by what is the age that the person is, the insured person, when the policy starts. And the insurance company calculates that premium. They calculate their risk using statistics to look at, what's the length of time on average that person will live, right? So they, based on a number of different factors, come up with a premium for that person over time, starting from the point when the policy initiates until that maturity date. And that premium stays constant, maturity date or death, whichever comes first. Now you can see also there's another line there, and it's kind of a curved line, which is the cash value of the plan. So one of the things about whole life is that it really is composed of two components. In a sense, the death benefit or insurance part of the product, and then the cash value that is accruing over time as the person's paying their premium. Now, really, you could say that it's kind of a one or the other situation. So, one of the things that people get confused about, they think that when the insured dies, that the beneficiaries would receive the death benefit and the cash value that's accrued over time. That's not the case. When the insured dies, the beneficiary receives just the death benefit. So, the cash value that's there is a benefit. It's what's called a living benefit. It's a benefit for the insured. If they choose, they have access to that money. They can use it. They can take actually policy loans against that cash value, but they have to pay that back. Or um, they can also, uh, instead of taking that cash value in terms of a loan, if they decide at some point along the way that they want to close out the policy, then the policy's accrued cash value will be distributed to them. So, in a sense, the value with whole life is that it's not just insurance, it is accruing some value as well. So, if you ever exit the policy, if you ever decide to terminate it, it has some value that will come back to you. Here's an example in straight whole life of, just kind of what I was talking about a moment ago, but with a little more description on the slide. So you can see on the top left, that's the portion that's the death benefit. And then you see on the bottom, the cash value accruing. And you can see that at the point of policy maturity, again, typically age 100. In this example, it goes all the way to age 120 before it matures. That's the point where the cash value actually equals the death benefit. That's the definition, in a sense, of policy maturity. And one of the nice features of these plans, though, is the premium is guaranteed to never increase. So a person can bank on, this is what my cost is uh, every month over my entire life. So you can see also that the death benefit is guaranteed. So it doesn't matter what age that person should die, that full death benefit is going to be available. And this is part of the attraction of a whole life policy. There's never any wonder, will the policy be there or not actually at the point of death? And we saw that, with term policies that are defined for a specific term of time, the difference with whole life is that it's literally is there for the insured's entire life. So the beneficiaries are guaranteed in that sense to receive that death benefit. All right, there's some variations in whole life. What we see here are some an example of limited, and also what I'd like to describe as a single pay whole life. So you see at the top the example of ordinary whole life that we've just been talking about. It's a different graph, but again, you see there's a set annual premium, there's a set death benefit at the top, and you have that accrual of cash value. When you have limited payment whole life, then you can see that the annual premium, which is that light blue line here, it stops, right? It doesn't go for the person's entire life, for the insured's entire life. So the limited part means it's the premium is only paid for a limited period of time, and that's defined in the contract. Why would somebody want to do that? Why would you front load, in a sense, those premium payments? Well, sometimes people would prefer to pay things off early. We think of that in terms of loans also, right? We might have a loan where we take it out over a long period of time with lower payments, or we might decide, look, I'd like to get that paid off sooner and get it taken care of, and then not have to make any more payments. Same thing here. It's just giving the policy owner, the insured, an option to, in a sense, pay those premiums off sooner. Now, as you might imagine in that scenario, those premiums then are going to be higher, just like if you wanted to pay a loan off sooner, you're going to pay higher premiums in that shorter period of time in order to reach that goal. There's another product called single pay whole life, and there's not a very good graph example of it. But if you can imagine compressing that all of the premium down into one single payment, that's single pay whole life. So let's say at age 50 or so, I decide, look, I didn't buy a whole life policy. I got some money that's put aside, and it's a chunk of change, and I want to make sure that I'm covered. And I also maybe I want to guarantee that my children receive some sort of benefit. And I haven't planned for that, or I don't feel like there's enough there in what I have planned for. So I can do what's called a single pay whole life. So that's condensing all of my life premium payments into one lump sum premium payment. So as you can imagine, maybe I have $50,000 set aside. Single pay whole life is saying, here, insurance company, take my $50,000. How much coverage will you give me for that? Well, in that case, and you can see this is true in the limited pay whole life as well, the cash value of the plan is sort of instantaneous. In other words, the insurance company takes that and says, okay, we'll make this worth more, to you by you turning that 50,000 over to us in one single payment. So it would have immediate cash value. I don't have to make any more premium payments, and one of the nice things then is also that the death benefit is going to be higher. So maybe if I were age 50 and I put down a $50,000 single pay premium on a whole life policy, that could buy me 80, $90,000 even of insurance coverage. So if I were to die tomorrow, my $50,000 would go to be 80, 90, or even 100,000, depending, on my age. To my beneficiaries. So it's a way of, in a sense, creating that immediate higher death benefit with a single lump sum payment. So uh, again, you're just changing those three variables. Remember that we talked about. So if I make a single payment, I can make a limited payment, or I can stretch my premium payments out over the entire course of my life. Those are all different options that are available to me. All right, now one little caveat here is, that single pay whole life example that I gave you. The insurance world, actually IRS, has some limitations there, and the limitation is that if a policy has a paid up premium in less than 7 years, right, then IRS is going to view that as an investment that can be taxed. Now, one of the benefits of insurance overall is that it goes to your beneficiaries tax free. But some investors had tried to use life insurance as a kind of investment vehicle. In other words, a kind of tax shelter for themselves to put money into. And the IRS, through this rule, kind of, made that not possible. So it doesn't mean that the single pay whole life is a bad product. It just means that it's going to be considered a modified endowment contract because you're paying all of the premium in less than 7 years. So again, it's going to have immediate cash value. Now, when it comes to taxation, a simple way of thinking about taxation of benefits is that, as I just mentioned, the benefits going to your beneficiaries are going to be tax free. If you take growth money, while you're still alive, however, IRS is going to tax that. So remember, I said that if I put down $50,000, immediately it's going to have some more cash value. If I try taking out that cash value or cashing out the policy, any gains that are on that that I've made above my premium that I've put in are going to be taxed. So easiest way that I remember thinking about it is if there's no gain, I'm not being taxed. But if there is a gain, a growth of interest or cash value, then I am going to be taxed. And now on these products, you're taxed on that if you pull that out before age 59 and a half. And it's considered LIFO tax, which is called last in, or means last in and first out. That's just a fancy way of saying that the money that is in last in, which would be the interest over my premiums that I put in, that again is going to be part that could be taxed. So main thing to know for modified endowment contract is it's going to be applied if the policy is one in which you pay those premiums off in less than 7 years. So that other example, that limited pay, where we paid the premiums off in 10 years is not going to be considered a MEC or a modified endowment contract because it took more than 7 years to pay the premium for that whole entire policy. Here's another variation on on whole life. It's called graded premium. Again, what are we doing here? What's happening with this product? It is offering flexibility or a different way of paying the premium. Again, different strokes, different folks, different ways of going about paying the premium. It's going to suit certain customers to pay less in the earlier years of the policy. Let's say maybe I was age 25 or 30 when I took out this policy, and maybe I'm not at my top earning potential yet, but I know that I'm going to get there. So I'd rather structure my payments to pay less in the early years of the policy and grade that up so I'm paying more as my income hopefully rises. The total amount being paid is going to end up being the same, but it's a different way of slicing the pie, slicing the premium payments to make it suitable or more amenable to a particular customer. So you can see here that the death benefit is still going to be the same. It's just the premium payments that are being modified or graded. So I gave away what the next kind is, modified premium whole life. This is a same concept, again, just really a different way of slicing the premiums. Instead of being graded, it might stay level for earlier years and then take a jump up at a particular point in the policy. So, graded, modified, both of them mean you're adjusting that premium variable. You're making it work in a way that's more amenable to that insured's needs and their financial situation through time. All right, joint whole life. This is a way of covering two people under one policy. This is something that's most commonly, of course, done with married people, spouses. It can also be done, though, with business partners. This is a way of having a two-for-one life insurance policy. So rather than having the expense of, one spouse having a policy, the other spouse having a policy, they put themselves together under one policy. What does that do in terms of premium? It's going to make the premium less, right? Because you're combining two into one. And really, this has a payout of just the first to die. So the first to die in this case would pay out to the other one. So that's a good way of, a couple covering themselves, either spouses or business partners. That way they know whichever one were to be gone, the other one's going to be covered, receive that death benefit, and be able to cover the losses from that other person not being there. Now, an extension of this is called joint and survivor whole life. So not just that those first two, the couple or spouses. Again, this is very common for kind of policy for a family to put together. So you're going to cover those two people under one policy. So spouses are covered under that policy. They determine the premium by averaging together their ages. And again, the premium is lower than having two different policies. Now, in this case, it's the second to die that is going to generate a payout to the beneficiary. Why? Because this is really primarily designed for couples who want to make sure that their children receive a death benefit. So maybe financially, they're okay if one or the other of them were to die, or maybe they have a policy already to cover that. But this case, they want to make sure that when the second one of that couple were to die, then the children receive that payout, that death benefit. So this is a good tool for estate planning, and it's a less expensive way of doing that, again, rather than having two separate policies. Let's look at some other varieties. Again, when we say varieties, remember it's going to be those same four variables that are moved in different ways that create, products that are more suitable or attractive to different buyers. So just revisiting those, remember our four variables: the face amount, that's a variable that can be changed, the cash value, the premium, and then time. How much time do I take, over time that I'm spending on the premium? How much time does it take for the cash value to accrue? So it's the interaction, again, of those four variables. So let's look at some different ways in which those variables are moved around. One product that changes things is called interest sensitive whole life. And this is a way to increase cash value faster because, honestly, in a straight whole life policy, the cash value accrual or accumulation is not very rapid. And in fact, in the first number of years, you can see the graph lines. It's pretty slow for that cash value to accumulate and gather very much. So, as a response to that, insurance companies came up with a way of accelerating or being able to enhance that cash value growth. How do they do that? Well, the insurer invests a little bit more aggressively with the funds that are coming in terms of premium. So that more aggressive investment can in turn increase the death benefit, or it could be used to decrease premiums. So remember, those variables can all be used to support or adjust or enhance each other, right? So the insurance company can give you that benefit of having more cash value, or they could say, over time, we're actually going to, maybe make your premium uh, lower. Now, in this graph, of course, the premium is staying level, and we're showing what could happen in terms of just increasing that cash value growth. That is the most common use of this product, is to get a kind of steeper curve, a quicker accumulation of cash value, and that's something that's attractive to certain customers. Now, adjustable life is a way of blending some of the benefits that we learn about in our other training on term insurance along with whole life. So, adjustable life blends whole life and term into one policy, in a sense, trying to gather or gain the best of both worlds. We learned in that other training, one of the benefits of term insurance is that you can get a higher face amount, a higher death benefit for less money, for less premium. So, somebody may want that higher death benefit, but also want that security of whole life insurance. So, a blended product can work to accommodate both of those interests. So, it is flexible. You can adjust the face amount and premium in these products to kind of fit the needs of that customer, and you don't have to issue a new policy to make changes. So there you can, adjust, especially over time. A person might say, I want to have a higher face amount at this time. So adjustable life is a way of accommodating or creating a little bit more flexibility than a straight whole life product. Now, when you want to talk about flexibility, universal life insurance is the product that I kind of jokingly say it's a flexible everything bagel. Those variables that we talked about, that again are listed here: face amount, cash value, premium, and time. In a universal life insurance policy, all of those variables can be adjusted in the policy as you go through your life and the life of the policy. Let me give you an example. Why would this be attractive to somebody? Well, so far we've talked about some flexibility, like in terms of face amount or maybe premium. Universal Life takes that a step forward and further than that and says, what if we let you actually skip premium payments if you wanted to? You could have a chunk of time where you don't pay any premium because you've got enough cash value in there. We'll use some of the cash value, we'll decrease the cash value to pay your premium. So remember, You can't have everything on your everything bagel all at once. There's a kind of give and take. So if you want to skip premium payments, it's going to reduce that cash value. Your other options might be, you maybe decide I want to keep the cash value the same, but I'm okay with reducing the face amount of the policy, in order to not have to pay premium for a period of time. Um, all of those factors then are variable and they can be changed throughout the life of the policy without having to, again, rewrite the policy. So, this, in a sense, is the most flexible product because it allows you to flex on all four of those variables. So, you might wonder, well, why doesn't everybody do this kind of policy? Well, as you can imagine, it can get a little bit complicated. And quite honestly, your average consumer may not always use this product in the wisest way. And they can actually, again, start slipping into thinking I can have it always, meaning I can have that same face amount, or they forget about the fact that, wait a minute, I'm really reducing my face amount a lot, or my cash value is really drained, or because they skipped so much premium. So the flexibility can definitely be a good factor if you're a wise consumer, but it can work against you if you're not. In fact, there are instances on these products where if you're not careful, you can actually almost completely reduce the face amount or eliminate the cash value or have very high premiums that might be prohibitive for the person to keep the policy. So there are some caveats here. There are some things about universal life that are really great in terms of its flexibility. But again, if the consumer isn't careful, they can actually run out of coverage, which would go against the value of whole life or permanent insurance if the policy ends. So again, now a lot of these policies do have some safeguards in there, some safety rails, maybe like a guaranteed minimum death benefit, but it's a has a lot of moving parts, so that can work for you. Sometimes can work against you. Now, this next one, equity index universal life, is simply another way in which you can, have all those variables of universal life and have that cash value tied to an S&P stock index. So anytime you see that word index, if you're taking the exam or equity index, you know that that means it's tied to the S&P stock index. So how does that help? Well, it can help you in terms of growing that cash value. Can it work against you? Well, again, usually these products have a kind of minimum rate, a safety rail there for you, but depending on the returns on the S&P, it might create greater growth or it may stay a little bit flat. All right. Now, regular whole life, straight life policies can also be variable whole life. So, similar to universal, there is some variability here. Cash value, in this sense, is the variable. Now, in traditional whole life, the insurer has the risk. When they take your cash value, that's what insurance companies do. When you pay them premiums, they don't sit on that money. That money gets invested and they invest it and they take the risk. They're the ones who are choosing the investments and they're taking the risk. Um, in a variable whole life policy, the insured still has, in that sense, the insured, the policy owner and the insured person has the risk because the cash value is not guaranteed. So these products will still have a death benefit that's guaranteed, and they also have a fixed premium. So, those parts aren't what's variable. It is the cash value that's tied to the variable. So you might do better on this product, but again, you might do worse than a straight whole life policy. So with a variable universal whole life policy, then again, the cash value is the variable. Now, in this case, the insured directs where the cash value is invested. So you have more control as the consumer, because in the other products, it's actually the insurance company that is choosing the those investments. In the variable universal whole life model, it's giving that consumer even more choice. They get to direct or tell the insurance company, this is where I want you to put my money in terms of investing it. So it is flexible, right? Now you do have to with these products that have that are tied to an S&P or they're variable like this, you may need a securities license in order to sell these products, not just your insurance license. So keep that in mind. But for the test, you need to be aware of what these products are. So keep in mind or remember, universal means flexible, right? They're flexing all of those different four variables that we've covered. The premium, the face amount, usually again, it does have a guaranteed minimum, but it's going to be flexible. And there we have it. We That concludes our session on whole life insurance policies. I hope this has been helpful for you to understand the value of permanent life insurance and also to see the many different ways in which it can be offered based on changing around those four variables that we learned about. Those are the basis for creating this variety of products that can be offered to your customers to make it really suitable for their needs. I also hope it's been helpful for you to learn these concepts so that you can pass your life and health insurance exam. Remember to check us out if you haven't yet at lifehealthexamcoach.com. We are really interested in helping you pass that life and health exam so you can get started in your career. So check us out, and thanks for watching today.